Hello everyone, my name is Josh Yanamoto and welcome to InvestorThread.com. Today we got to talk about Capri. This is a fashion brand. The ticker symbol is CPRI. And you may or may not realize, personally I'm not that familiar with this enterprise, but this ticker, CPRI, has been moving incredibly quickly and robustly in recent sessions. And right now it's almost, I think, at $42, something like that, or very close to $42. And the implied volatility in this bad boy is significantly higher than historical volatility, than what you would normally expect the volatility ranking to be. And so there's a lot of financial incentive to sell options. Now, in my opinion, with the high implied volatility, there is an incentive for a credit-based strategy. Now, whether you want to go credit up or credit down is always going to be a question mark. Given the incredible technical momentum of CPRI, I'm hesitant to have a credit down perspective. So I believe in the credit up hypothesis. So that means applying a bull put spread strategy. Now, this is just an idea. It's not investing or trading advice. This is just an idea that I'm bringing forth for educational purposes. But you may want to consider it simply because of what you're being given. Okay, so this is for the options chain that expires November 15th. So basically a month and a half from now, this is when this options chain will expire. And so given that it is a bull put spread, we are going to focus, of course, on just put options. So this is how the trade breaks down. We're going to sell the $30 put, which as of Thursday's close had a gross premium of 360. So 360 is the gross amount that we're going to receive as credit. And to complete the other side of the bull put spread strategy, we're also going to buy a put at a lower strike price. In this case, we're going to buy a $25 put, and this has a gross premium of $2.05 at the time. So we subtract the 360 from 205 to get our net credit or net income that we receive, which comes out to $1.55. Now, what is at risk for this trade? Now, 155 is the maximum reward that we can hope to achieve or receive in this trade if it goes in our favor. And in terms of the maximum risk that we're going to incur if the trade does not go favorably, is the difference between the $25 and $30 strike prices minus the net premium of $155 that we already received. That comes out to $3.45 per contract, or $345 when you apply the options multiplier of 100 shares. So we can gain $155 and we have to put at risk $345. In my opinion, this is compelling because the break-even price for this trade is only $28.45. And the security itself has closed on Thursday at around $42. Let me look that number up real quickly. Yes, so almost $42, $41.97 to be exact. So basically $42. You essentially have a gap of around 33% from the break-even price of $28.45 to where the stock is at nearly $42, and the stock itself can drop about 29% and still get the maximum reward. Because remember, with this bull put spread, you want the security to land at $30 or higher than $30. So you have this massive, you have a massive safety margin to $42. Okay, there's a massive safety margin to $42 that the security can, it can trade from here till a month and a half from now. Right now it's trading at $42. As long as it doesn't drop below $30, you're going to receive maximum income of $155. And if it stays somewhere above $28.45, you will receive some profit from this trade. So this is incredibly compelling, because a lot of bull put spreads that are out there, even for high volume option markets, you're not going to find such a big gap to in terms of the safety margin from your open market price to the highest price or to the threshold of maximum profitability. That gap, you're not going to find typically a vertical option spread that has close to a 30% gap from the open market price down to the minimum threshold to receive maximum profitability. And you're talking 33% gap from the open market price to the break-even price. So 33% margin of safety. Now, if it goes below 33%, of course, then there is that risk of the trade being not profitable, and then the other side exercising their right, and then you would be assigned essentially. Then you would lose. You'd probably end up losing the maximum amount. But to lose the maximum amount, basically for the stock to fall to $25, that seems very, very unlikely. To me, it seems unlikely that the stock is even going to drop to $30. But even if it drops to $30, you will receive maximum income of $155 for this options trade. Let me look up. This is a very compelling yield. You're getting a yield. It comes out to a yield of 45%, almost 45% in a month and a half from now. Of course, when I say yield, I want to be very careful, because that 45%, to receive that 45% yield means that this trade has to go well. But the likelihood that this trade is going to go well seems very high in my opinion. Again, right now the stock is trading at $42, and it can still drop to $30. Okay, it can drop down almost 29%, and you can still receive maximum income from this trade, a yield of 45%. Folks, you're not going to find a yield of 45%, and this is a pretty high probability trade. Let me just look up. Almost 74.62%, guys. 74.62%. 75% probability that this trade will be at least somewhat profitable. And from the gap, that safety margin that you're receiving, folks, if there really is no such thing as an options trade that sells itself. But I'm telling you, if there was such a thing as an options trade selling itself, this bull put spread strategy for Capri Holdings, ticker symbol CPRI, it might be it. Okay, you got to get on board. At least consider the idea. Because this is a 45% yield with a 75% chance of being at least somewhat profitable on this trade. Come on, It really, really does not get any better than this.